Hi, everyone. Thanks so much for joining today's Corporate Connect. My name is Gerald, and I'm happy to be your host for today. So this evening, we are very pleased to have with us UOB Group, where we will be able to get an update from the company. We are very pleased to have an audience from Facebook as well as Mumu Live, and we are happy to share that this webinar is organized by SIAS and supported by SGX Group. So I believe UOB doesn't require much of an introduction. It is not just one of the leading banks in Singapore, but also across the whole of Asia. So what we are going to do today, we'll start off with a presentation by Mr. Geoff Howie, who is a market strategist at the SGX Group, and he'll be sharing with us some of the key market updates. Next, we are going to have Ms. Jasmine Loke, who is Vice President Investor Relations of UOB, who will be giving us some of the key company updates. We'll thereby go into a Q&A session where we will be happy to be taking questions from participants in today's seminar. So without further ado, I'll hand over to Geoff, who will give us an update on the market.
Thanks so much, Gerald. Just moving into my screen sharing now. Yep. What I'd like to just share, obviously, a quick disclaimer tonight. What we're presenting is educational material. We're not making advices to buy or sell stocks and so forth. So this is the normal way that we do present at the SIAS events on these webinars. I just wanted to quickly take 10 minutes, just 2 slides only. The first slide, there were just a few things I just wanted to quickly share, as I think this is the first time I'm speaking on the SIAS webinar Corporate Connect series for this year. The first is just to relay, obviously, the STI has still been generating highly competitive returns. When you compare the STI's 17% US dollar total return since the end of 2019, it really has kept pace with the regional Asia Pacific benchmarks, as well as the Asia Pacific ex-Japan benchmarks. At the same time, we've also outperformed the ASEAN region considerably more, even though that our Singapore stocks make up something like a quarter of the weights of the key ASEAN indices. And the trio of banks, which are obviously in the focus tonight, particularly one, make up around 11%, 10% thereabouts of all the ASEAN indices. Second point is that the STI still does continue to maintain a pretty strong element of independence from the other global benchmarks, with no significant daily correlations to a host of relevant benchmarks that we detail in the right table, top right table. When you're looking at finance, R squared above 0.7 would generally be seen as a high level correlation, whereas a measure below 0.4 would be seen as a low correlation. So what you can see highlighted is that the APAC banks and the global banks do have some significant, well, not significant, but not insignificant impact on our STI movements. And that predominantly is because 45% of the STI is actually comprised of the 3 banks, DBS, OCBC, and UOB. Next thing I just wanted to mention is rounding up the numbers for retail investors. For each of the past 4 years, retail investors have been net buyers in the Singapore stock market. If you look at overall, since the end of 2019, there's been something like 15 billion Singapore dollars of net buying by retail into our stock market. And the basic revealed preference theory shows that net retail flow over the past 4 years has had somewhat of a pattern. That is, retail investors have overall been more active buyers when the STI underperformed its peers, as opposed to times of comparative outperformance. So I guess overall, at the moment, we have obviously this tighter financial conditions continuing, China's strategic economic policies. They are 2 overarching market drivers that have carried over into this year, and the fluid developments, if you will, continuing to keep investors on their toes. Geopolitical concerns have also been a real strong mainstay since 2019. And it's probably no surprise to investors that while the STI has maintained competitive returns of the region, it's actually our gold ETF, which has actually doubled the returns of the STI with a 40% gain in US dollar terms since the end of 2019. So straight on to my last slide, second slide for the evening. As we said, the STI Banks, DBS, OCBC, and UOB comprise 45% of the STI weight. The three banks themselves have also generated average total returns of 45% since the end of 2019. And that brings their average annualized total returns over the past 10 years to 9%. Also, looking beyond the STI, I just wanted to throw in that the banks, as we said, they make up 15% of the FTSE ASEAN index, and that combined weightage actually notches up to 18% for the FTSE ASEAN Target Dividend Index. And this dividend index is designed to achieve 100% dividend yield increase compared to the parent base FTSE ASEAN index. And it also looks to address concerns such as index turnover, yield traps, concentration, and so forth. So these banks have pretty high yields. For the full FY23, DBS is set to pay dividends in the vicinity of 5 billion Singapore dollars. OCBC is paying dividends in the vicinity of 3.7 billion Singapore dollars, and UOB is set to pay dividends at around 2.8 billion dollars for the FY23. So that comes to a combined 11.5 billion. Now, what it means to investors is when you take the closing prices of the three banks at the end of 2013, the end of their financial year, those distribution amounts generate a 6.0% average dividend yield for the trio. For the FY23, the combined total income of the banks increased to 48 billion Singapore dollars for the year. And the trio at the same time averaged pretty high productivity efficiency ratios with an ROE average of 15.3%. So you take that 48 billion Singapore dollars of total income, 33 billion Singapore dollars came from net interest income, which was up 22% from FY22, and then 15 billion of the 48 billion came from non-interest income, which was up 18% from FY22. For the trio of STI banks, you've got net interest income, which is driven by net interest margins as well as loan growth. And your net interest margins, obviously, in turn, are very much impacted by interest rates. So non-interest income, it comprises activities such as wealth management, fund management, brokerage, and insurance. Digitalization measures. There's a book. I don't think Jasmine will have time, but this is the book I really recommend. It's actually, you can't actually see it. There it is. Driving Digital Transformation by Dennis Koo. If you want to read about digitalizations of the banks and how Dennis Koo built the Tomorrow app, this is your book. If you don't have a copy or you can't find a copy, email SIAS and I'll send you mine. And if you promise to send it back. So that's, talking about the non-interest income aspect, as we said, wealth management, fund management, supported by digitalization efforts as well. UOB saw its actual FY23 non-interest income grow the most of the three last year. I think it was up 32% from FY22. Net interest margins really did drive the net interest income increases for the three banks last year. DBS reported a group level annualized NIM net interest margin above 2% last year from below 2% in 2022. OCBC and UOB also reported annualized NIMs above 2% last year from below 2% the preceding year. And that net interest margin in NIM is an indicator, obviously, of banks' efficiency. It reflects the difference between revenue that they receive from their interest-bearing assets and the actual expenses that are associated with their interest-bearing liabilities. Combined net interest income for the trio in the fourth quarter of last year came to 8.3 billion Singapore dollars. This represents the fifth consecutive quarter that the net interest income was above 8 billion Sing dollars. So if you look in the top right chart here, you can see combined prior to the second quarter of 2022, you had a long time where all three banks reported combined net interest income between 4 billion Singapore dollars and 5 billion Singapore dollars every quarter. However, the higher interest rates saw the combined quarterly net interest income increase to above 6 billion in the second quarter of 2022, to above 7 billion in the third quarter of 2022, then surpassed 8 billion in the fourth quarter of 2022. And as we said, 5 consecutive quarters of net interest income above $8 billion. And you can see that purple line, how the compounded SORA rate has increased in line with the actual net interest income increases. And that's also coincided with the Fed funds rate, which have been hiked between March of 2022 and July of 2023. Now, currently, when you're looking at the expectation for US interest rates, the CME Fed Watch currently estimate that it's either June or July FOMCs that is now the most likely time for the first rate cut by the Fed Reserve this year. That's very different to what we were expecting 3 months ago. 3 months ago, we were expecting we would have our first rate cut this month in March, next week. So after the June FOMC, there's something like 4 FOMC meetings. And by the end of the year, I think majority expectations are you're going to have between 75 bips or 100 bips in rate cuts. UOB economists say it's going to be 3 bip cuts most likely. So 25 bips cuts most likely is what the UOB economists are saying. The key indicator, though, for the US is, of course, the US PCE core deflator. That was at 2.8% in January. Between now and the 12th of June FOMC, you might not see the PCE core deflator moving as the Jerome Powell is looking for, sustainably moving enough towards 2%. You're going to have February, March, and April PCE core deflator numbers released. And if the momentum in the PCE core deflator that we saw between October 22 and January this year continues, your PCE core deflator would be around 2.4% to 2.5% at the 12th of June FOMC. So as we said, that might not be seen as sustainably moving close enough to 2%. So then if it is, though, you're going to have still attention to continue to hone in on growth indicators. Are we seeing slowing growth in the US? And also wages in the US labor market, are they coming down to a level that could see the Fed move in June? But using, I guess, the most simple modeling type of analysis for the PCE core deflator, you don't actually have it potentially hitting the 2%, 2.0% in the month of June. It's rather it's rather likely to hit 2.0% if the momentum continues in the month of June, but not released until the end of July. So you're going to, if the momentum in the downward momentum in the PCE continues, you're going to have it hitting 2% for the month of June, which would be released on the 26th of July. And then you have an FOMC shortly after at the 31st of July. So that's where a lot of the bets are at the moment for when the Fed actually does make its rate cut. Obviously, the impact of tighter financial conditions, it has been somewhat of an overarching driver, not just for the likes of REITs, but also banks, which has impacted banks' loan growth as well. Nonetheless, for the 3 banks, the FY20 results did show that the customer loans were relatively stable last year. If you express it in constant currency terms, then your gross loans at the end of FY23 were up 2% for UOB and OCBC and up 1% for DBS. Going into this year, the DBS CEO noted that while higher for longer rates does support net interest margins, there is a likely trade-off with loan growth, and the bank expects for this year net interest income to thus be around last year's level. The CEO also maintained guidance for the NII to be supported by the full year impact of its Citi Taiwan's consolidation when he had his March press conference with the full results of last year. CEO Helen Wong of OCBC has also noted the bank is targeting again an ROE between 13 and 14%. And she also noted while the global growth slowdown is anticipated this year, the bank does expect Asia to perform better. And then also recently, UOB CEO Mr. Wee did maintain that he is optimistic about ASEAN's potential, driven by improved domestic demand, robust tourism economy recovery, I should say, and strong investment flows into the manufacturing sector as companies continue to reconfigure their supply chains. So as we said, very fluid outlook on the interest rates, not to mention the growth outlook, particularly with China's role and trade perking up as well. And this is really impacting our banks on a day-to-day basis. So this is a good segue to bring Jasmine in, and I'll conclude here and stop sharing. Thanks so much.
Geoff, I happen to have a copy of the book as well. So for viewers who are interested, you can ask me for a copy too. But thanks so much for sharing the chart on the dividend. I think that is something that we always get a lot of questions from investors on. And I guess with that, we will actually get Jasmine to share what have been some of the key drivers towards UOB's earnings and how that's enabled you to be paying out a higher dividend.
Thank you, Gerald. So, hi, good evening. My name is Jasmine, and I'm part of the investor relations team at UOB. Glad to have all of you joining tonight. So, our agenda for today's presentation, I will first run through an overview of UOB Group, and we will talk about the bank's growth driver, as well as our consistent long-term track record of executing our goals. And finally, I'll be happy to take your questions during the Q&A session. So moving to slide 4, I will start off with this slide, overview of UOB. So there are a lot of info on this slide, but the key message is that we have been around for a long time, close to 90 years, and the founder's family has always been involved in the bank. And our CEO, Mr. Wee Chong, is the third generation of family running the bank. And his family remains the largest shareholder with around an 18% stake. I won't be going through all the numbers as well, but basically at the end of last year, our balance sheet remained healthy with strong capital and liquidity positions, and they are well above the regulatory minimum. We have also generated around 14.2% return on equity to be able to continue to reward our shareholders like yourselves with increasing dividends. UOB is also one of the highest rated banks in the world. We have strong AA ratings by the 3 credit rating agencies. And moving on to the next slide, I'm sure all of you here know who we are and what we do. We provide full banking services across key segments in retail, wholesale banking, as well as treasury and asset management. And as a leading bank in Singapore, we have also received strong recognition in the industry, as well as from the investment community. And our market share for Sing dollar deposits and loans are more than 20%. So this next slide is a very interesting slide. It shows our growth story. It is very interesting because it shows the net profit trend over the years for UOB. And as I mentioned, we have been around for close to 90 years. So if I were to chart that, I'm afraid I won't have enough space in this slide. So we have gone through the war. We have seen various economic crises, pandemic, and we have remained profitable throughout. Our net profit, if you can see on the screen, it has increased from just 92 million in 1980 all the way to 6 billion in the recent 2023 results through various organic as well as inorganic growth. The most recent of all is the acquisition of Citigroup's consumer banking business in the 4 markets, Malaysia, Thailand, Indonesia, as well as Vietnam. And the entire acquisition has been successfully completed in 2023. And on the next slide, again, this is a very wordy slide, but the key thing I want you to focus on is the part on the left that shows our footprints in the region. And this is what makes us different because we are the only Singapore bank that have the breadth and depth in this region. And with the city acquisition, we believe our presence in this region will deepen further. So why is this important, you may ask? I will talk about it when we look at our growth drivers in the next section. And on the segment performance on the right, I just want to highlight that retail contributes around 40% of our operating profit, while wholesale banking contributes around 60%. So I will elaborate more on our strategic priorities on slide 9. So in UOB, we have 3 strategic priorities. So number 1, tapping on rising regional affluence, and that's via our retail business, capturing cross-border opportunities via our wholesale banking, as well as sustainability. So in retail, we want to be the bank of choice for aspiring individuals in the region, tapping on rising affluence and also growing digitalization in Southeast Asia. We see large potential in ASEAN with more than 600 million population that are young, dynamic, as well as with rising affluence. And our value proposition for our retail customers is through a personalized touch, providing solutions for our customers throughout their life stages and also their lifestyle preferences. And this is done across various online as well as physical touch points and through what we call the omni-channel approach. So for wholesale, our ambition is to be the number 1 trade bank within ASEAN. So how we differentiate ourselves is through our strong connectivity, as well as our deep industry knowledge and specialization to support our clients as they expand overseas. And together with our deep and entrenched ASEAN footprint, like I highlighted earlier, we are well placed to capture trade as well as capital flows within the region. And lastly, sustainability. This is a very important area which we also want to focus our efforts to create real impact. As you all know, Southeast Asia is one of the areas that are most vulnerable to climate change. So as a leading financial institution in this region, we see our role as a catalyst to influence the real economy towards net zero. But at the same time, we want to balance this against the socio-economic growth in the region as well. And in 2022, we announced our net zero commitment. So we continue to support our customers in their transition towards lower carbon economy by providing them with sustainable financing solutions. And on the next few slides, actually summarizes the key operating performances of our strategic pillar. I won't be going through each and every indicator, but I'll just summarize the performance. So for consumers, the city acquisition, which I highlighted earlier, has accelerated our growth in the ASEAN region. We now have more than 8 million retail customers. And with this enlarged presence, we are able to forge strategic partnerships with established brands across the region, as well as to extend lifestyle offerings to them. I'm sure you have seen news about Taylor Swift's concert in Singapore last week. And as the official partner for the concert, UOB cardholders are given exclusive pre-sale access to the ticketing. And we hope to be able to curate much more of these offerings for our valued customers like you, so that you can use your UOB card more frequently. And on the digital front, our digital banking app, UOB Tomorrow, has also allowed us to deepen our engagement with customers across the region. And if you see on the bottom, as a Singapore bank, we continue to benefit from net new money inflows to Singapore as a wealth management hub. And we hope to cross-sell this AUM into wealth management products when sentiments improve. Next, on wholesale, our wholesale banking has also performed well amidst a challenging macro environment. We continue to build our customer franchise while playing to our strength in connectivity. So over the years, we have actually invested about 800 million in the last 8 years to boost our digital platform, as well as our trade, supply chain, and also cash management capabilities. And all these investments has accelerated our reach to our customers within the region and putting us in a very strong position to capture a larger share of the cross-border trade transactions. And next, Moving on to sustainability, we have also extended more than 40 billion in sustainable financing. And in this space, we have started to see more sustainable finance adoption from just green buildings to also sector-wide economic activities. And we have also published our net zero progress report, and we are very happy to see that we are making very good progress on our net zero commitment. And moving forward, we continue to look for opportunities to support our clients in their decarbonization efforts. And I will just run through the next section very quickly as well to show you the trend of our consistent track record. So on the left chart, you can see how our loan base has increased by more than 10 times in the past 2 decades, while keeping asset quality resilient, as represented by the non-performing loans ratio on the right. So we have never compromised on asset quality while growing our loan book. Sure, I mean, our NPL ratio was quite high during the Asian financial crisis in the 1998 aftermath. But however, since then, we were able to clean up the book and strengthen our credit underwriting policies. And as a result, you can see that our NPL ratio has been maintained at very low level and very stable between 1.1 to 2%, despite the various economic cycles that we have been through since 2007. Next, what makes up our loan book? So having a diversified loan portfolio is also very important to UOB. Hence, you can see from this slide, our loan book is diversified in terms of industry, geography, as well as customer segment. So in terms of industry, real estate exposure represents around half of the book, which makes up by housing loans as well as building and construction. And despite this concentration in property, the asset quality track record for this sector has been very resilient, with most of our assets located in Singapore, and also thanks to our prudent underwriting selection of our clients. And the rest of our exposures to other industries are quite broad-based and diversified. And in terms of geography, our loan book is anchored by a strong home base of Singapore, which makes up around half of the loan book, and complemented by higher growth markets outside of Singapore. So we'll always maintain Singapore as a key market for us, given Singapore's AAA sovereign rating and also the strong corporate governance here. And outside of Singapore, we have exposures to some of the regional markets such as Malaysia, 10%, and Thailand, 8%. But we are very selective in these markets because we don't aspire to be a bank for everyone in these markets, but we are going after the niche segments such as the mid to high affluent retail customers, as well as the large corporates with cross-border ambitions. And we aim to keep around this proportion for our geographical diversification. And in terms of segment breakdown, large corporates and institutional clients form the majority of our loan book. And because we are also a full-service commercial bank, we also have meaningful exposure to retail banking as well as SME customers. Next, at UOB, our business is mainly funded by customer deposits. So we have spent a lot of effort and strategy over the years to cultivate trust from customers and to build this strong deposit franchise. So on the retail side, we aim to be the main transacting banks for our customers, while on the wholesale side, we have been strengthening our cash management platforms to serve the needs of our clients. And in terms of the deposit mix, as you can see on the pie chart on the right, we continue to build our low-cost, stable, current account and saving deposits franchise, which represents around half of our total customer deposit mix. And on the next slide, so our steady loan growth, backed by our diversified funding, as highlighted in the previous 2 slides, has translated to a resilient income and also profit growth over the years. So as you can see in this slide, even during difficult economic periods like the Asian financial crisis or the global financial crisis, or even the recent COVID pandemic, you can see that UOB continued to post positive profits, Sure, the growth in earnings may fluctuate for a year or two, but we always weather through these periods and emerge stronger. And on the back of this consistent improvement in profits, we've been able to pay out more dividends to our shareholders as well, which many of you will be happy to hear. So moving on to the next slide on dividends. In 2023, we have paid out a total dividend per share for the full year of $1.70, up 35 cents from the previous year. So for us, we continue to maintain a dividend policy of 50%, because with this policy, we believe that shareholders like yourselves can be assured that we are able to use our capital efficiently to support our earnings growth and yet deliver a consistent and increasing return to our shareholders in the upcoming years. So this is my concluding slide. To sum up, what investors like about UOB. So number one, we have a stable management. As an owner-operated bank, the interests of the management team are aligned with our long-term shareholders. And secondly, with a diverse footprint in Southeast Asia, we give investors the upside of growth and also rising affluence in the region while applying Singapore's standard of corporate governance. Lastly, we are a bank that has weathered through numerous ups and downs of economic cycles over the past 90 years, and that has consistently delivered on growth, earnings, as well as dividends. I think with that, I have come to the end of my presentation. Thank you for listening, and back to you, Gerald.
Thanks so much, Jasmine. I think you need to give a wave, cause your lights have gone out.
Yeah, this is to help to improve our cost efficiency here in UOB.
Okay,
Energy
so
saving.
good to be able to see your face again. So with that, we'll actually open up the Q&A session. For participants who have joined us today, if you want to be asking Jasmine any questions, do go into the Q&A box and put in your question there. I already see that we have a question that's come in, so I will progressively be taking these questions together with those that have been pre-submitted. Okay, so we'll start with a question around how does the higher interest rate environment actually affect your company's earnings? I think everyone has observed that we are now in a higher interest rate environment, say versus 2 or 3 years ago. So maybe you can walk us through how do you see that impacting the different line items that you have and your different profit drivers?
Yeah, so overall, we see that a higher for longer interest rates are still positive for banks. As you can see, I mean, in the recent 2023 results, we have delivered a very good set of financial results and to a record 6 billion. And that's driven by strong income growth. And part of the income growth is actually driven by a strong net interest income. Our net interest margin actually grew about 23 basis points for the full year, which drove our NII to grow by about 16% for the bank. So a higher interest rate environment continues to be very positive for the banks. But having said that, generally when the interest rates are high, people will now worry about the debt serviceability of customers, right? Which will in turn drive the non-performing loans for banks. However, I think for us, we don't look at interest rates in isolation when it comes to asset quality, because there are other important and if not, equally important or if not more important drivers such as unemployment rate, national savings, as well as economic growth. So that said, I think a lot of people have questions about asset quality generally in a higher interest rate environment. So we continue to be watchful of the impact it's going to have on our loan book. I mean, although we do expect a marginal uptake in NPL as borrowers adjust to the highest interest rate, but I think for us, overall, we saw that our asset quality has remained quite benign. Our NPL ratio is low and is within the 1.5 to 1.6 range. We also do not see any sign of systemic stress in terms of asset quality. And more importantly, we are comfortable with our current level of provisioning buffers. And the risk is also mitigated through diversification as well as stringent credit selection.
Okay, so I think you shared quite a number of different things in the response. I will go through each of them, starting from your loan growth.
Mm.
I think we have observed that the economic growth is actually slowing down compared to what we have seen in previous years. Maybe you can share how this has actually impacted your loan growth and how do we think about loan growth going forward?
Yeah, so I mean, in this uncertain macro environment and also the high interest rates, it has continued to dampen demand for our loan growth. So more importantly, I think we still see good growth in the region actually in 2023, but that has been offset by repayment, especially from our corporate clients, because I mean they want to repay their loan because in a high interest rate environment, they can save on some of this interest expense. However, I think going forward, we expect loan growth to pick up in this year, more back-end loaded and also in selected segments. I think firstly, I think there are also pent-up activities from corporates because they cannot hold off their capex investment permanently. And also we are seeing some bright spots in terms of the supply chain diversification, like the EVs and also sustainable financing. So we do see that there will be a pickup in growth, loan growth this year, and led by all these bright spots.
The other key driver that you mentioned was around the net interest margin, especially in the interest rate environment that we are in now.
Mm,
I think looking at your net interest margin over the last few quarters, it has started to come off slightly.
mm.
If you can share with us what is the driver for that and how do we think about net interest margin going into 2024?
Yeah, sure. So I think the general view is that the NIM has already peaked, and this year it will start to moderate down. So, and I think because in the recent Fed outlook, they have already turned more dovish. So in terms of our house view, I think just now what Geoff has mentioned, we expect that the Fed fund rate will remain at current level until the second half of 2024, whereby we price in about 75 basis points of rate cuts. And based on history, we should see there will be a rebalancing of the income driver. And I think for us, there were NIM pressure in the last few quarters, but that was mainly driven by a few factors, right? So there was a combination of repricing of the deposit book and also focusing on high quality customers. That's why we are willing to take a lower yield. And I think more importantly, it was because we have conservatively shore up our liquidity in light of what's happening in the macro environment. So although it pressures NIM, but overall it's actually earnings accretive because we use this excess liquidity and we actually invest it, we actually put them with government securities which are safe, and it overall contributes to our total income. So I think for us, we know that liquidity actually comes with a cost, right? But we prioritize the strategic flexibility that comes with it. So let's say if loans were to pick up, we can deploy the loans. And if the loan growth will not pick up until the second half of this year, we have a room to actually optimize and manage all these excess funds, such as converting them into wealth management products. So I think it gives us a lot of flexibility, and we actually guided our investors to look at total income as opposed to just NIM because we expect loan growth to also pick up, and the cross-selling to wealth management products will also drive fees for us. So I think overall, we are very diversified. We have diversified range of revenue drivers, right? So overall, a total income would be more indicative of the growth the profitability that we should see this year.
So then that brings me to the next question, which is the other part of your total income.
Mm-hmm.
That comes through from your fee income, which has actually grown very strongly over the past few quarters. Can you share with us what are some of the key drivers for the fee income growth and how do we think about that going into 2024?
Yeah, so for fee income, I think for us, it's actually made up of three big components. We have the loan-related fee, and that's driven mainly by corporates. There's also the credit card fees and also wealth management fees, right? So for credit card fees, it actually hit a record high in the whole of last year, and that's a reflection of our expanded regional franchise after the acquisition. As I've mentioned earlier, our brand preference has actually improved significantly in the ASEAN markets. And also a lot of effort has been done to actually strengthen the brand as well as the card programs and offerings for our customers to drive spending in our customers. And this is coupled with, of course, the continued consumer confidence post the pandemic. So, but more importantly, this enlarged franchise and ecosystem has allowed us to curate more value proposition for our customers, which drives our credit card fees. And we feel that the card momentum should continue into this year with strong growth. Another very big component for us, right, in terms of fees would be wealth management fees. And a large component of this, right, is because Singapore, we are a regional wealth management center. So I think for us last year, we saw that banca sales has remained very resilient, although the equity market has been quite soft. So that has impacted the wealth management fees a bit. But towards the end of last year, as we saw the dovish pivot by Fed towards rate cuts this year, we saw that actually fixed income sales have actually picked up towards the end of last year. So all these three products actually drive fees. So wealth management fees, we have banca sales, we have equity sales, we have fixed income sales. So we feel that for this year, wealth management fees should pick up. And another bright spot would be our AUM. So if you were to see in the slides earlier, our AUM actually grew quite strongly, about 14% year on year to close to 176 billion. So there's a lot of cross-sell opportunity for all this to actually generate more wealth management fees for us. So going into this year, our fees would be led by mostly our consumer franchise, which continues to be very, very robust. And it actually shows that customers are very confident and the momentum should go on.
For the participants who might not be familiar with banca sales, can you maybe share a bit about what that is?
Yeah, so we have this tie-up with Prudential, whereby we will distribute their products. So this will be all the bank assurance products. So we are distributing the products for them, and in turn we actually earn a fee which is under this wealth management fees. So for us, our wealth management fees are made up of bank assurance sales, equities, as well as fixed income product sales.
Okay, thanks for the explanation. I think the other thing that you alluded to was the growth in the credit card fees from the acquisition of Citi's ASEAN business.
Mm-hmm.
Can you maybe also share around how that has impacted your different business lines and how that will actually drive UOB's profit going into the next few years?
Yeah, so maybe I'll just update on the progress of this acquisition. So we have completed the acquisitions for all four markets, and we have successfully integrated our portfolios in Malaysia and Indonesia last year. So by the second quarter of this year, right, we would have integrated the Thailand portfolio as well, and followed by Vietnam by next year. So this acquisition, we have added close to, I think, 2 million customers. So our retail customer count has surpassed 8 million. And overall, it actually helps to increase the whole franchise. So now we are like the number one card issuer in Singapore, number two in Malaysia, and also number three in Thailand. So in terms of business, Citi's strength was in credit card as well as unsecured lending. And this is complemented by UOB. Our strength is in deposits as well as secured lending. So there are a lot of cross-sell opportunities. And the priority now is to continue to build the franchise and to uplift the customer spend as well as to strengthen the deposit balances. In terms of financials, we saw that our credit card fee last year went to a record. So in terms of financials, right, this portfolio from Citi actually helps our revenue in a few ways. So the biggest of all would be NII. So with their deposit and unsecured lending, they will yield NII, credit card fees. Yeah, so these two are the key ones. So we expect this acquisition in the four markets will give us around a 1 billion incremental income per year by these four ASEAN markets. So that will give us an income lift. And we are very excited to actually unlock the value from this acquisition this year and going forward.
Okay, since we started talking about individual markets, I'll take some of the live questions relating to each of the different geographies. There's this question around Thailand. I think Daryl noticed that some of your allowances, NPLs in Thailand seem to have gone up. Can you maybe share a bit more about why that is the case?
Yeah, so for Thailand, we had a one-off provision made, I think, sometime in the third quarter last year. And that was mainly due to one corporate, and it was a fraud case. So we have fully provided for this case, and it is a one-off. So we don't see, we don't foresee that the issue will be systemic. And I think right now this case is still ongoing, and we have fully provided for it, so we are quite comfortable. I think other than that, in Thailand, they have a new government, so there will be a lot of reform, structural reform, and I think the focus will be on economic growth recovery, and also they are a beneficiary of, sorry, the light. Yeah, so we are quite optimistic of what's happening in the Southeast Asia region. I think for Thailand, it's still supported by domestic demand, and also I think we do see tourism kicking up. Like I think recently they have announced visa-free travel for Chinese tourists. So I think this would be all the exciting things that we will see in the market in Thailand, and we are positive on the growth as well in Thailand.
Okay, so moving from Thailand to China. So maybe you can share some insights around like how does the property sector slowdown actually affect your business? Any concerns around NPLs there?
Yeah, so for China, I think we still see good growth last year. I think that's on a few sectors, but overall, our Greater China exposure, is maybe I can just highlight our Greater China exposure. So for our Greater China exposure, it makes up around 15% of our portfolio, and our Greater China strategy, right, has always been focused on wholesale banking. So in terms of I think the onshore China mainland real estate exposure is very, very small. And it's mainly to network customers. I think we have disclosed it in our results slide. So we are very comfortable because our lending to the real estate sector in China are focused more on tier one cities, and these are completed properties that are generating cash flow. So we don't foresee there's any issue with it. I think more importantly, these are to also network clients and the names that we know very well. So overall, we are very comfortable with the portfolio in China. And yeah. So our China strategy is that we focus more on the connectivity because we make money from China and not in China. So we use our network there to actually originate deal and then bring it back to Southeast Asia. So that's our strategy there in China.
Hi, this is Howie. I'm Jasmine's colleague. I just want to make it also add some color to what Jasmine said. Yeah. Just to be clear, we don't do mortgages in China. We have a very small mortgage book, but that's been run down. So just to add to what Jasmine mentioned, the exposure to property in China is mainly to network clients, and the exposure is mainly commercial, fully tenanted properties in tier one cities. the reason why we are there is because we follow our customers there.
Yep.
Okay, thanks so much, Kawing, for sharing more about your exposure in China. I think the other thing that this participant, Mr. Poon, noticed is that you have less branches in Greater China. Is there more background you can share around that, and how does that actually tie in with the strategy you mentioned earlier?
Yeah, so I think as I've highlighted earlier, right, because I mean, unlike our peers, we do not have our business there is mainly focused on wholesale business, supporting our customers expanding overseas into China. So we don't have a significant retail presence at all, I mean, in China. So hence, I mean, in terms of branch count, I mean, if Mr. Poon were to compare it with our peers, it will be lesser because we are mainly our focus there is mainly our wholesale customer. Does that answer the question?
We'll move on to another region that Denver has questions on, which is commercial real estate in US. So the question is, are there any concerns around the exposure towards this segment?
Yeah, sure. So this question has been asked by a lot of investors. So we have disclosed that our office exposure makes up around just 7.5% of our portfolio, and about half of this are in Singapore, which we are very comfortable with because Singapore office market continues to be very resilient with strong occupancy level. I mean, we continue to attract corporates, global corporates as well as MNCs to set up headquarters here. And also as a wealth management hub, we are also seeing healthy demand for wealthy individuals setting up family offices in Singapore. So half of them, they are in Singapore, so they are very, we are very comfortable with it. And for the US, gateway cities like UK, US, and Australia, to his question, our US exposure is very small. It's just about 0.8% of our total loans portfolio. And most of it are actually lending to network customers, and they can be your sovereign wealth funds as well as state-linked corporates expanding overseas, meaning they invest in all these real estates in the US. So most of them, they have multifaceted relationships with UOB. So it's unlikely they will just drop the ball and then, leave us. So even if there's any issue, we see that because of our careful client selection with strong sponsors, they should be very manageable. And I think more importantly, the office portfolio that we have, they are secured by Class A office properties, and the LTV is very low. The average LTV for our portfolio in terms of office is only about 50%. So we are very comfortable overall with this whole office exposure, and yeah.
So we have gone through Thailand, China, US. Are there other key markets that you're looking out closely for in terms of potential asset quality issues?
Yes. So I think another, because our biggest market in the region is also Malaysia. I think Malaysia, one very important update is also this Singapore Johor Special Economic Zone, right, that has just been announced. So we see very encouraging sign because it will help to facilitate the movement of people, goods across the causeway. And if done well, it can actually replicate the Hong Kong Shenzhen model, whereby Shenzhen now is a very flourishing city. So we are now, trying to engage actively with all these official agencies as well as trade associations and business partners to see how we can leverage on this special economic zone to actually improve the business and also the economy for both countries. So this is one of the bright spots that we are looking out for.
Okay, moving on to questions relating to dividends. I think that's something at the back of the mind for a lot of investors.
Yeah.
How should we think about dividend payouts in 2024?
Yeah, so in terms of dividend, our capital position has been very strong. So our dividend policy has remained unchanged we have maintained that our dividend policy to be 50% of reported net profit, because we feel that this is a good balance between rewarding our shareholders as well as also investing in future growth for the bank, so that in the coming years we can reward our shareholders in terms of an enlarged P&L and also in terms of a higher DPS based on 50% of reported net profit. So I think for last year we have seen that happening. We have actually increased our dividend by about 35 cents year on year, and we will continue to reward our shareholders, but yet balance this with growth to actually continue to deliver strong growth and value to our shareholders.
The other aspect of dividends is your scrip dividends. Quite a number of questions here as to when you will resume your scrip dividends.
Yeah, so maybe I'll just explain scrip dividend scheme for the benefit of those who may not know what is this. So it's actually an option to elect to receive shares rather than cash amount for your dividends. So for us, our capital ratio, our capital position has been strong. We ended the year with 13.4% CET1 ratio, which is well within our operating target of 12.5% to 13.5%. So hence, we do not feel there's a need for now to actually give out scrip dividends. But if you prefer to get more UOB shares, you can actually use your cash dividends to buy more of our shares in the open market.
Okay, thanks so much for sharing about how we should think about dividends in the year ahead. I think with that, we have taken most of the questions that were asked either pre-submitted or live. Would you like to provide any closing comments?
No, thank you very much for having UOB on this session again. We hope our participants on this webinar actually get to know more about UOB and also our exciting plans for the years ahead, and how as a UOB shareholder you can be rewarded. And if there is any question, feel free to drop us an email. We'll be happy to answer your questions. And thank you for your time.
Okay, thanks so much both Jasmine and Howie for your time today. For participants who are here with us tonight, we hope you found the Corporate Connect useful and informative. In case you want to rewatch part of this interview, you can actually catch the webinar on SIAS YouTube channel. So Corporate Connect is actually a monthly webinar. Do keep a lookout for other corporates that we'll be speaking to over the next few weeks. And with that, thank you for joining the session tonight. We hope you have a pleasant evening. Thanks so much.
Thank you.
Thank you.
Thank you.